Hello everybody and welcome back to our channel Anything Under the Sun. For today's video, we have episode 2 from the Money series. And in this video, we're going to have a look at some of the basics of building your investment portfolio. And please do note that this video is not a direct advice on investing your money. So when we look at building our investment portfolio, we start thinking of a few questions that are natural to come to us. Isn't having hard cash a much safer option? Because we keep hearing that with different investment portfolios, there is a bit of risk involved. Doesn't investing need a lot of expertise? Don't I need to be rich in the first place to start investing? And what is the difference between investing and trading? And very importantly, when do we start investing? I think it is very important to understand that you do definitely need a bit of expertise to start investing. This can be your own expertise, or you can consult an advisor who can help you with building your portfolio. And you don't need to be rich to start investing. You can start with a very basic amount, and the ultimate objective is to become rich. Investing versus trading, definitely there are differences. If you are somebody who would want to take a lot of risk and you're looking at acute or really short-term goals, then probably trading is a good thing for you. But please do remember that to become a trader, you will need to spend a lot more time than you would be spending when you're investing money for the long term. When do you start investing? We will have a look at it in this video. So we will start with that on when do you really start investing, or what is the ideal period to start investing. It's always said that the earlier you start, the better would be your returns also. Always before you start investing, please do have an emergency fund in place, which is typically considered to be at least 6 months of your current monthly income. For example, if you're earning about 50,000 rupees a month currently, you would have to save at least 6 to 12 times of that as your emergency fund, right? Which means at least 3 lakh rupees have to be set aside so that this is available for any sort of emergency that you or your family members or your dependents could run into. So that is something that you will have to start building before you really start investing your money elsewhere. Please do remember, there is no borrowing. Please do not take loans and start investing that. Please do not borrow money and then start investing. Once you have the emergency fund ready, then whatever money you can save on a monthly basis or on a quarterly basis or on a yearly basis, please do start investing that only. Try to acquire some basic knowledge on investing before you start, at least of the different asset classes that are available, what are the risks involved in each of these classes, and some basic knowledge which is now freely available over the internet. There are multiple books available, there are multiple blogs available, there are multiple YouTube videos that are available. You can have a look at these before you actually jump into investing your money. A very, very important thing that many people do not develop, and is one reason why many people drop out halfway during their investment journey, is they do not have the discipline to have a regular investment in place. So they may have the josh to start it off, but 2-3 months down the line, they start losing interest in this investment, and then they suddenly remember only after the next 6 months or 12 months, and this discipline is lost. So it's very, very important to have a good discipline, and you will have to set aside a portion of your income so that you can keep investing on a monthly or on a quarterly or on a yearly basis as whatever suits you. Just a very quick example of how time plays an important role in the corpus that you can accumulate. So in this video you can see that there is a fictional person who starts investing at the age of 27, and she does the bare minimum investment of just 10,000 rupees every month, and she's been investing for about 33 years, which is till the age of 60. And just assuming that the rate of interest for her investment is about 12% per annum, the accumulated corpus is somewhere around 4.5 crores. And this is the power of compounding that time plays whenever you start investing really early. Let's assume the same person maybe has missed out another 10 years of her life and starts investing only at the age of 37. Still, the same 10,000 per month is the investment. The time available now till she retires at the age of 60 is only 23 years. Keeping the same rate of interest of 12% per annum, you can see the corpus is so small when compared to what she would have got if she had invested from the age of 27. It's only 1.32 crores now if she has missed out a span of just 10 years in her life. Just consider even further, if she starts at the age of 47 only and every other parameter remains the same, the corpus that she can accumulate is only 35.4 lakhs. So this picture shows the power of compounding, the power that time can play in your investment portfolio, and the ultimate point here is that you should start as early as possible. Now that we've looked at when you should start investing, the second part of the video is going to focus on how to start investing. So first thing you'll have to do is, like I already said, create an emergency corpus. Make sure you have an emergency fund in place. Also, you have adequate insurances in place, your term insurance, your medical insurance, and so on. So once all that is done, once the basics are done, then you will have to assess your own risk profile. So you can fall into a low risk profile, moderate risk profile, and a high risk profile. A very basic parameter is your age. So as you grow older and older, it is recommended that you take lesser and lesser risks, but that is not the only parameter. Even at a younger age, you would want to take lower risks, so that also is okay. So make your own risk profile assessment. Are you willing to take a lot of risks, or are you just looking at safeguarding your capital? There is a common association between the risk and returns. Higher the risk, higher the returns. That is the common funda, but it's not always the case. But in majority of the cases, the more riskier a particular investment is, the higher would also be the returns. The second thing on how you will have to start investing, there are two options. One is a lump sum investment. The other is an SIP, the systematic investment plans. So there are pros and cons with both. So for example, a lump sum investment is basically you put in, say for example, you have received about 1 lakh of bonus, okay, in the month of March, and you want to put that entire amount of 1 lakh in the market or in whatever investment portfolio that you want to do. That is a lump sum investment. On the other hand, a systematic investment plan is you've already received this 1 lakh, you would probably want to split it into 10,000 over the next 10 months. Okay, so this is your SIP or your systematic investment plan. So the major advantage of doing an investment on an SIP basis is something called as a rupee cost averaging, which is derived from the US version of dollar cost averaging. As you know, particularly with the markets or the investment classes where the returns keep varying based on time, it's very important to follow SIPs, because you know that you will be on the long run, you will be sort of averaging the cost at which you're buying this particular investment or the instrument, and you are able to sustain your returns also. You should have to study a bit of the different types of asset classes, and you will have to choose whichever suits the best for you. And always remember, like they say, do not keep all your eggs in a single basket. Try to diversify as much as possible among the different asset classes that are currently available. And when you choose asset classes, you should always choose a few that are a bit riskier. You should also think of something that would protect you from major losses. This is called as the concept of hedging. So once you take a risk on one of your instrument classes, you should have something to balance this particular risk that you're taking. So this is the concept of hedging. For example, if you're investing in the stock market, which is highly volatile, you should also invest maybe, say for example, on gold on the other hand. So it is said that whenever the stock market crashes, the price of gold shoots up, and vice versa. So this is the concept of hedging that you should also be aware of. So basically you will have to diversify amongst the base asset classes that you are choosing. A very simple example of how your investment portfolio can look. So just assume this as an example. This is not an investment advice, but this is an example of how you can diversify your portfolio. So here you can see about 25% of it is in mutual funds, about 25% are in stocks, the direct stocks. There's about 10% in fixed deposits or high quality bonds, 10% is in gold, and about 10% is in real estate, which can be commercial, which can be residential, of which you can also be generating incomes. 10% is liquid cash, and another 10% can be anything else, including the cryptocurrency, the various bitcoins and the altcoins that are available. So this is an example portfolio. that you can probably look at to diversify. But if you are somebody who is really new to investing, probably you would have some cash and you may have started some FDs and you may be having some gold. You may be having real estate with you. But maybe if you are a beginner in investing, maybe you can start off with a few mutual funds, and maybe a few of the really good stable stocks. That could be a good area for you to start with. So some of the key points to remember from whatever we've discussed so far. First thing you'll have to do is make a risk profile assessment of your own profile. Have an emergency fund in place, at least 6 months of your current income. And create your own plan, a customized plan that would suit your own needs, and very importantly, diversify your portfolio. Start early, and very importantly, be consistent and disciplined in your journey towards investment. Please do not invest based on the news that you hear from others, a few tips that keep going around in various social media groups and so on. So please do your own assessment, your own analysis of whatever is happening, and then start investing. So this was a very short video on just the when and how can you start building your investment portfolio. In the next video, we will also look at the different asset classes, what are the risks associated with each of these classes, what are the benefits, and how can you really start entering each of these risk classes. So just to close this video, I think the key message is that you will have to start early and you will have to be consistent also in your journey throughout. If you did like this video, please do click on the like button, do share your comments below, and also share this video with anybody who would benefit from this video. And if you have not already subscribed to our channel, please do click on the subscribe button and also the bell icon right next to it so that you keep receiving notifications of our future videos. Thank you very much, and thanks for watching. Keep safe.